Good. Yeah. Still active with the city council, left the attorney general's office. Okay, just too much. You don't need hours.
Would you like to begin with housekeeping comments?
Yes,
Chair?
Wayne, please.
Thanks. Ron can begin the housekeeping comments.
Thank you for participating in today's meeting. Please do not connect to Zoom or teleconference while in the room, and please silence all devices. Click on the globe at the bottom of your screen to select either English or Spanish. Public comment will be taken after each item. If you are in the auditorium and wish to comment, please use the iPads located in the lobby. For meetings in other locations, please complete a blue speaker card and provide it to a South Coast AQMD employee. Speakers may be limited to a total of 3 minutes or less for all agenda items, and times may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. Word time will be allotted for Spanish translation that is not simultaneous. For questions or issues on public comment, please call the public advisor at 909-396-3247. That's 909-396-3247. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Be aware that this meeting is being recorded. By participating, you are authorizing recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
Good morning. I'd like to welcome all of you to today's March 8th, 2024 Hybrid Investment Oversight Committee meeting. I'd like to ask Jenny Pierce to please call the roll.
Supervisor Hagman. Board Member Padilla-Campos is absent. Mayor Solache. Richard Dixon.
Here.
Jill Wynot.
Present.
Chair Cacchiotti.
Here.
We have 3 present, 1 absent. I believe that's a quorum.
I believe so. Is that correct?
Yes, that's the quorum.
Okay, great. Thank you very much. So we'll move on right now to our first discussion item, quarterly report on investments, and our Chief Financial Officer, Sujata Jain. Sujata, go ahead, please.
Good morning, Chair. Good morning, members of the committee. Sujata Jain, Chief Financial Officer. So this item is to report the cash balance in the LA County Pool surplus and special purpose investments. And as of the end of the fourth quarter that ended on December 31st, 2023, the balance was $1,263,156,653.41. The composition of our investments are 88% in the LA County Pool surplus and 12% in special purpose investments. The earning rate for the month of December was 4.13%. And on page 4 of the report, you can see the yield comparisons of some of the other counties in our region, and we are pretty much all earning similar earnings. And with that, I'll be happy to take any questions on this item.
Committee members, any questions for our Chief Financial Officer? Jill, no. Richard, do you have any questions?
No, thank you very much. As usual, it was a good report.
Okay. And Sujata, the only question I have is, I would ask this on page 3, was the U.S. Treasury note that matured on 2/29/24, I believe a week or so ago, right before a board meeting, at $40 million. What was our decision in that? I know we talked about that last meeting, and Kurt brought a couple of ideas. What did you guys decide?
Yes, good question, Chair. So that did mature, and I have reached out to LA County, and there is, we'll be reinvesting that. And most likely, LA County is looking at giving us a 5% or better rate for a nine-month investment.
Would that be a U.S. Treasury note or a CD?
They haven't responded yet, but I have sent it, and I'll be getting a response perhaps today or by Tuesday.
Great, great. And just let Supervisor Heigman know, what we talked about the last meeting was that $40 million Treasury note had matured 2/29, and we're just asking a question. They're looking at LA County. Okay, good.
Thank you, Chair.
Thank you,
Shop
Sujata.
San Bernardino, maybe we'll give you more. We have a fully solvent retirement account.
Any more questions for Sujata? Great. Is that your report?
That concludes this report, yes.
Okay, great. Is there any public comment for this item? If you want to comment, please raise your hand. And I don't see anybody in the auditorium coming forward. Wayne, anybody online? No? Okay, we'll move on to the second item. Thank you, Sujata. Great job. Item number 2 on our agenda. Let's go to financial market update. Richard Babb from Senior Managing Consultant, PFM Asset Management. Welcome, Richard.
Good morning, Chair, members of the committee. As we bring up the presentation, what I want to do is give you sort of the key takeaways that we've got, is that we are past peak interest rates for this cycle. The Fed's done raising interest rates. The key question for the markets is when and by how much will the Fed start cutting rates? Economically, it seems like the base case is no recession or a soft landing, no hard recession at this time, but significant risks do remain. Go to the next slide. I won't read the next slide. It's in the agenda package, but it talks about some of the things we're going to discuss. If we go to the next slide, the next slide will show the Fed's forecast of economic events. Yeah, perfect. That. And what the thing to keep in mind is the Fed has 2 key mandates: stable prices, meaning inflation low, and that full employment. Where they're going to go with Fed policy sort of depends on how these things are. So you see, this is what their forecasts are. Change in real GDP, they expect to slow down this year. Unemployment rate, expect a slight increase. PCE inflation, they expect it to continue to trend downward. And the Fed funds rate, their key rate, they'll be cutting it as the year progresses. If we see significant deviations in the underlying economic factors, we could see the Fed change policy, but we seem to be on sort of this glide path right now. If we go to the next slide, we're showing you inflation. So this chart, the top red line, at least to my eyes, is the overall CPI inflation rate. And we can see that it was 3.1% in January of 2024, down slightly from 3.4% in December. The different colors represent different components that make up that overall 3.1% rate. And we'll see some of that breakdown on a slide or two. No, keep going. But the thing that I really want to point out is that blue color. That is the services sector, which also has included shelter. And what we've seen is that's very persistent high. We've actually seen year-over-year deflation in energy prices. Goods prices is basically flat or slightly deflationary. That's what's sort of really driving inflation and what the Fed is concerned about, because it's very sticky. If we go to the next slide, so what we show here is that the chart on the left is showing you the cumulative change in prices from December of 2019 in a percentage bit by the different colors you show, like the blue is energy. Then on the right, you see the components as of the January report. A couple of things that you'll see that energy on a year-over-year basis went down by 4.3%, but its weighting in that overall CPI percentage is only 6.7%. So its decline to CPI is 0.3 negative. One thing that I want to point out is the biggest increase was in transportation inflation at 9.7, but since it's weighted only 6.3% of the overall index, it had very little impact. You can see that shelter, and we'll talk about that more on some coming slides, was 6.1%, but it has a significant weighting of CPI. So it was the biggest contributor to why that's keeping up. The other thing that I want to point out is when people were talking about inflation coming down, what's important to talk about is that we're talking about the rate of change. For budgetary reasons, you've got to always remember that the chart on the left shows how much prices in overall have increased in the past several years. So even though the rate of inflation may be coming down, prices in general are much higher than they were several years ago. Next slide. So this, we just want to highlight. The red line is the overall CPI rate that we saw on the prior slide. The blue line is that shelter, just the inflation rate in that. And again, this isn't a weighted, this is what the actual comparison is on a year-over-year basis. And you can see that when inflation overall peaked up very quickly, shelter takes a long time to catch up with it. You've got a lease in place, you have, mortgages and other things that are in place, and it takes time for those to turn over. But once they've turned over, they don't drop back down as things start to soften up again. So one of the reasons it remains sticky. Next slide. One of the things, though, we're worried about is on this chart, what we're showing is CPI on two components. The blue is the core, the bars is the core CPI. That excludes food and energy. So it tends to be less volatile, sort of the key part of it. They also have a thing called supercore that the Fed's been paying attention to, and that's that orange yellowish line, which is supercore, which excludes from it also the shelter component of it. So they want to see the things that are driven more by wages. While overall inflation is coming down, what's somewhat worrisome for the Fed is when you see the past few months, both in the core and the supercore, they've been trending up on a month-over-month basis. And remember, if your average, a month-over-month change of about 0.2% equals the 0.2% equals roughly the Fed's 2% target. But what you see is that, supercore accelerates to 0.8% inflation, so much higher than what the Fed's target is. And that's one reason people are saying, well, Fed should be cutting rates already. Inflation's down, but there's still worries. And it was interesting in his testimony, Powell acknowledged that the Fed was probably too late in raising interest rates when inflation started to heat up. I think we can all see that now. But he's sort of saying, we're not making that same case now. We're not holding rates up too long. So we'll see how it plays out. The next slide, again, going back to that, not change slides, but for reference, go one more. Sorry about that. As I was talking about on the first slide I talked about was the Fed's two key mandates were inflation and full employment. So this is now we're talking about the employment rate. On the chart on the left, we're showing you the unemployment rate. And this was as of the January report. We actually got the February report out this morning. And a couple of things that I want to point out is the unemployment rate nationally was 3.7% in January. It went up to 3.9% in the latest report. Again, the Fed actually wants about a 4.1% unemployment rate. So from the Fed's perspective, that's a good thing because it's softening demand on employment. One thing that I also noticed is that you look at the California overall rate and the rate for Riverside, San Bernardino County, Ontario, MSA, it's been increasing. So it's well above what the national average is, despite being almost at the national average several months back. So that would be somewhat worrisome. If we look at the chart on the right, these are the monthly changes in payroll, so actual amount of payroll numbers. The number that came out today was 275,000 jobs added, which is above the 12-month average of 230,000 jobs. But we also saw that they revised the prior 2 months by a cumulative 167,000 jobs. So what I would say is, overall, the job market remains pretty strong. The job growth remains favorable on an overall basis. But we are seeing more signs of weakness in certain elements of it. In fact, if we go to the next slide, the chart on the left is the JOLTS report data, job opening and turnover survey. And the blue line is the job openings, the number of jobs available out there. And then the reddish line is the number of unemployed people. In the latest report, which is actually 1 month further than what's shown here, is that ratio of jobs available to unemployed people is 1.45 to 1. That's down from where it was at 2.2 jobs for every unemployed person in mid-2022. The Fed would actually like to see that closer to about 1, meaning 1 job available for each 1 unemployed person. From the Fed's perspective, if there's too many jobs available, it creates, demand in the labor force part, so people will demand higher wages. From an individual employee, yes, I want my wages higher. From the Fed, trying to cut inflation, they don't want to see inflation. They don't want inflation driven too much by wages. The other thing in the dynamics of the job market that we want to show is on the chart on the right. The blue line, the darker blue line, is the labor force participation rate, overall rate. So if I broke it down by prime age, which is 55 and under, it would be higher. There's more people in that. If it was above that, it would be lower, but it's about 62.5%. And you can see that the blue line, which is the Congressional Budget Office forecast, they see it continuing to trend down based on demographic changes. So again, it remains about where the Fed does, but we're definitely less people in the job market than we were prior. But if you go back to the 50s or very early 60s, it was like in the 50% range. So we're still above what that is. Next chart. One thing that we wanted to show on this chart is that the blue line shows wages on a year-over-year basis. The red line shows inflation. And what we're trying to show on this chart is that finally wages are starting to exceed inflation. So again, that's one of the things key to driving consumer growth and GDP is that consumers have money to spend. So that's a favorable sign. Next slide. As far as consumer sentiment, what we show on the chart is the consumer sentiment on the left and expected changes in the right. One thing is you see that they're very volatile. Consumers can be affected by whatever the current thing is. But one thing that's been favorable is consumer sentiment's generally been positive, meaning it's upward trending on the left-hand side, and that their expectations of inflation have come down. They think inflation is getting more in control. And that's good because if you're worried about inflation, it will change your spending dynamic. So if you think it's more stable, you feel more comfortable, that will continue to allow you to spend. If we go to the next slide, this is showing you GDP, so what the net impact is of all of these factors. So the bars are the individual quarters, and the blue bar was the latest quarter, fourth quarter. And actually it was been revised. This was the preliminary number, the advanced number, so that when it was second revision came out at 3.2, essentially the same. For the whole year, GDP grew at about 2.5%. One thing that's important to remember is the Fed sort of considers economic potential of the U.S. economy at about 1.8%, 2% in that range. So we've been growing stronger than what the Fed would have expected normally type of situation. We are expecting, the Fed's expecting the economy to slow down to, I think it's 1.4% in 2024. But that's sort of in the latter half of it. The Atlanta Fed has, I think, 2.5% is their forecast currently for first quarter GDP. The thing that I would say is overall economic conditions remain favorable, but there are risks out there. And we'll talk about those some later, but some of the more global things is what happens in the Mideast, what happens with Ukraine, what happens in China, a lot of other things. So while basic trends are favorable, there could be negative impacts. In fact, if we go to the next slide, consumers drive the economy. So how are consumers doing? You look at the chart on the left, consumer loan delinquency. So this includes all sorts of revolving debts, car loans, credit cards, those types of things. And you can see that it's definitely been increasing recently. People, especially on the margins, are becoming more stressed, which could impact their ability to spend. Though if you look back from the chart, you can see that it's still relatively low by historical standards going back to the 2000s. But it is a worrisome sign. The other thing is on the chart on the right, we're showing you personal savings rate. It's peaked very significantly during the pandemic because the federal government was doing so many stimulus payments. But people have spent those down, especially on the margins of that. So this is something that could be problematic going forward, that certain elements of the population are definitely more under stress. Next slide. And we can see this in one fact. This is retail sales, and then the component parts of that is on the right. And what we see is that it was down in the latest report, that people were a little more constrained. But some of this is just volatility, but that's something we are watching. The nature of what they're spending on is changing. You know, furniture and appliances up, food services, meaning food out, is up. But, you know, motor vehicles and some of those are coming down. So the nature of how they're spending money is also changing. If we go to one more slide, this just quickly is business optimism. And again, how do businesses feel about all of that? What's interesting is business optimism is actually down and remains fairly low. Then again, that's somewhat worrisome. Though if you look on the right, that you see that inflation's becoming less of a worry, that the businesses also start to feel like those are coming down, and that while they're off their peaks, businesses are still expecting to have to that they'll be facing inflation and will have to raise wages as a result of that. Next slide. So what does this all mean? What this chart is showing you is Fed funds futures, and this was done in December. Fed funds futures is basically what the market's trading on, anticipating what that Fed funds target rate, the Fed's rate, will be at different points in time. And this goes out as of December 2025. The light blue line on the top was what they were thinking the rate would be at those points in the future at December 29th. The darker blue line, let me change that. The top blue line is the September 29th number. The darker blue line at the bottom was what the market was thinking as of December 29th. And what we see is, in the shaded area just indicates the 6-month range. After the Fed's December meeting, the market was thinking, oh, the Fed's going to cut rates, and very aggressive and very soon. They were expecting 6 to 7 interest rate cuts, and that the soonest would be as soon as the March meeting, which is March 20th. What's been interesting is, given the Powell's and the other Fed governors sort of browbeating the market and saying, hey, we're not doing that, giving that thing, we've seen the Fed's futures go back up, and it's sort of aligning with that top line right now. So what does that mean for interest rates? Next slide. This shows you during the quarter, and I won't spend a lot of time, but we can see how the market was reacting to every bit of economic news, and interest rates were going down. The 2-year in October hit a high of 5.25. It ended the quarter at 4.25. So again, interest rates came down. We're past peak interest rates. If we go to the next slide, This is showing you the Treasury yield curve out to 30 years. So again, 3 months to 30 years. The shaded area is the 15-year range. And then the dotted blue line was September 30th. The dark blue line was December 31st, the end of the fourth quarter. And again, because the market was expecting the Fed to cut aggressively, they drove interest rates. The 2-year ended the quarter at 4.25. Remember, I said it was 5.25 in October, so it's down significantly at the end of the quarter. It actually, in January, the 2-year went down to 4.14. We've actually seen, based on those expectations, the 2-year today is 4.45, much stronger. It was interesting, the discussion earlier about the maturing investment and everything else. Thinking back, if we'd been at the same meeting 3 years ago, if we were going, oh, are we going to get 4% or a 5% yield on our investments? I think we would have all been ecstatic. So again, interest rates are down, but we're in a level that's much more attractive than we were several years ago. If we go to the next slide. This is just to show you how things trended. So what we see, and I brought this to February 22nd, the 3-month, the red line, that sort of doesn't get affected by day-to-day things as much because it's based on what they think the Fed's going to do in the next 3 months. The 2-year, the blue line, is really affected by market events and what they think is going to happen. So what we saw is that rates on the 2-year went down significantly during the fourth quarter, the shaded area. But as I was talking about, as the Fed sort of talked them back off the ledge and said, no, we're not cutting that soon, we saw it climb up. And now it may start, it's trading in a range, but we'll start trending down as we get more into that window of the Fed cutting interest rates. And that concludes my presentation, unless there are any questions.
Committee members, any questions? Jill, Richard, any questions? Okay. Richard, we'll wait for you, but Supervisor Hyman has a question.
Oh,
I mean, there's a lot of numbers and I'm glad you understand it. But the previous thing on the inflation was the housing.
Yep.
And you always know there's multiple factors to housing. Same thing with multiple factors of why unemployment rate may be different in California than other states, because our minimum wage is now $20 versus $7. As we see those dynamics of companies moving and changing and stay competitive, I know a couple of my small businesses are moving their stuff back east and in the South because they just can't keep up the labor rates. When you drill down into these things on regional economics, our housing, because on the novice side, I'm here we're losing population in California compared to other states. So that demand on housing stocks, you would think to be less of a demand. I know we had a huge demand from 7-10 years ago. What are the factors of our rates being high on the housing? What's considering keeping those housing rates high?
Meaning that you have poor, in a sense, housing affordability in the state of California. Again, one aspect of it is there hasn't been a significant turnover in housing stocks. I think it's 60%, it could be a little off, of mortgages out there have rates under 4%. So a lot of people who have existing houses in prior cycles may have been very willing to sell their house, buy something new, and provide new opportunities for people. They aren't willing to do that. They want to hold on to the mortgages. In a sense, they're not going to lower their price or anything else. They're not in that demand. So we're not seeing turnover that. One, interest rates, mortgage rates just being so high, and even though they're going to start to come down, that's keeping prices. And yes, there have been demographic changes where the Southern California population is lost net, but I think some of those are reversing from some of the forecasts that I've seen now. Not that we're going to have significant growth, but we're going to see some rebound in that. So I think all those factors together will keep housing prices somewhat high here. And the difficulty is a lot of the available land nearby employment centers has already been built out. There's not that much more, and that the stuff that is available is commanding very high prices. So if you're going to build if your land price is high, you're not going to be able to provide a very affordable house. Those would be the things that I've seen, not to say I'm an expert in that specific area.
Oh, thank you.
Supervisor, it's interesting. We had a discussion about this at our council meeting just the other night. With the RENA numbers that came out last year, the high numbers, I mean, even a small city like South Pasadena, cities I represent, San Gabriel Valley, but in prior years maybe had requirement to build couple dozen, a couple hundred housing units, now had thousands. Built estate like South Pass had over 2,000. People were asking myself, and then we were at a regional meeting, saying, how come developers aren't building? I think it was, they can't get financing. It's just too expensive, won't pencil out. Is that what you're seeing?
Seeing it was interesting, though. I was talking to a client in the Antelope Valley. I think that's where it was. And the thing he was saying is what they were actually seeing good demand for their new homes, but it was because the builders themselves were providing the financing rather than, and they could offer below market price financing on it. So for those people, they were actually doing well. But I think globally, in terms of if you don't have that option, if you don't have a builder providing it, mortgage prices are still so high for so many people. Though it is interesting, if you're a new, if you're in 20s and 30s, mortgage at 8% seems very high. When I got my first mortgage, being 64, it was over 8%, and I thought I was getting a great deal at the time. So some of that's just generational perceptions and where interest rates have been.
Richard, did you have any questions?
No.
Thank you. And last question. If you had a crystal ball, as Kurt always talks about, what's your prediction for March for the Fed interest rates? Hold?
I think the Fed's going to cut. I mean, it's going to be interesting to see the next couple inflation reports. But I think a couple of things. If they wait too long, it becomes, one, we may have slowed down the economy, and they may also be worried about impacting the presidential election. In a sense, if you look like, oh, things are slowing down, we're contributing, we're going to favor one party or the other by what we're doing. So I think because they've already sort of telegraphed that they want to do that. Not March, I would say more in June.
June, that's what
June,
I was
I apologize. I was thinking, June, I think in March, I think they're going to give more indications that they're going to cut either in May and June, but not in March.
Okay. Thank you very much.
This is Richard. My view is that they're under pressure probably to do it sooner rather than later, because as you get closer to the election, the more concerned they are with doing anything.
Yeah, and that's it. And so that's why I think they'll telegraph. The Fed doesn't like to cut without telegraphing what they're going to do. They don't want to surprise the market. So I think that's why in March, they'll give a clear indication. The other aspect is in the March meeting, they'll also update their summary of economic projections. That was like that second slide I showed of the bars. And that'll give a good indication of where they see things headed.
Great. Wayne, any public comment online?
No.
Okay, none in the auditorium. Great, we'll move on to item number 3. Approve South Coast Annual Investment Policy and Delegation of Authority to the LA County Treasurer to invest our South Coast AQMD funds. Sujata.
Yes, thank you, Chair. So like you said, this item is to approve the investment policy with some changes from prior year, and also to renew the delegation of authority to LA County Treasurer to invest and reinvest South Coast AQMD funds. I'm happy to answer any questions on that one.
Committee members, any questions? Jill, no. Richard, any questions?
No questions, Mr. Chairman. If I may, I would move approval.
Motion by Mr. Dixon, second by Supervisor Hagman. Is there any public comment on this item?
There is not.
None in our building 2. Okay, well, roll call, please, Jenny.
Supervisor Hagman. Mayor Salache is absent. Board Member Padilla-Campos, absent. Mr. Dixon.
Aye.
Jill Wynot.
Aye.
Chair Cacchiotti.
Yes.
Motion passes, 2 absent.
Thank you, Jenny. Next item on our agenda is other matters. Item number 4, other business. Any other business members? Jill, none?
No.
Richard says no. No, I have none. Is there any public comment on this item? No. Wayne says no.
Nope.
None here. Public comment period. This is a chance for you to comment right now. You have 3 minutes. Any hands raised? Paul says no. If none in the auditorium. And finally, our last item is item number 6, next meeting, Friday, June 14th, 2024. Is that okay for everyone so far? Looks good, Richard?
Looks good to me.
Good, okay, great. Thanks, everyone, for your hard work, and thanks, Paul and your group, for keeping us going this early in the morning. Staff, thanks for getting here early. Have a great Friday. We're adjourned.
Thank you.